Hey everyone, it's Friday, September 2nd. I want to do a review on oil and gold. I'll start with oil. Oil recently had this big run up over here. Because it ran up so fast, it didn't really establish any support on the way up. What I mean by that is that you didn't see any back test or consolidation. It just went straight up. And so it decelerated to the downside really quickly as well because there wasn't much support established on the way up. It did create this new uptrend line here, which is currently defending. If we lose this new uptrend line, I expect it to test this longer term uptrend line that we have starting from back here. And what's been happening is after the February lows of 31.48, we set this new high up here at, what was the high? 53.42, and then we set a higher low, a lower high, and currently oil is trying to set a higher low again, depending on how we follow through. So we're range bound right now in oil as far as the charts go. What bulls would want is to break out of that range and break above this candle high here, which is at 49.36. And what bears want is to break the low of this candle, which is 39.83. As you can see that today was a bullish candle, and it's how we're going to get the next, the midterm move of oil is, I'm going to watch the next candle forming. The range of this candle is, the high of this candle is 44.67 and the low is 43.16. How the next candle breaks will determine the short-term movement of oil. If it breaks above 44.67, I'll take a bullish stance for the next couple days, and if it breaks below 43.16, I'll take a bearish stance on it next few days. Which, if it break below this, obviously mean it'll test this uptrend line here, and we'll see if it bounces there. A break of this, and I do expect us to test the lows of this candle here. Now let's take a look at gold. Gold on the daily, you can see that on Thursday we formed a bullish reversal off of the 100 MA, this line right here, and we had a nice follow through with increasing volume, which is a good sign for the bulls. Now, next week I expect us to test the middle Bollinger Band here and see if we can get above that. If bulls can get above that, that'll be really strong. What I would like to see for bulls is to get above this middle Bollinger Band and then back test it as support before we move higher. I don't want to see just a straight up move. That would be very, very bad, as the move can just come right back down without establishing support, as I mentioned in oil. Also coinciding with this 100 MA is Bollinger Band right here, which it also defended, so the lower Bollinger Band. So something to look to next week is the defense of this, is to see if we can overcome this middle Bollinger Band. If you see these big moves on gold, like today, let me draw some ovals for you guys. This move here, here, and here. What these moves are economic events where news is released. This was non-farm payroll. This was Brexit. This was FOMC, and this was non-farm payroll today. And what's happening is that the news is bad economically, or is the sentiment of the news is bad. Today's payroll didn't meet expectation numbers, so that's why gold went on a rampage today. And what that's doing is it's making it hard for the Fed to justify a rate hike, and that's why these news-driven events are helping gold have these incredible spikes. If you look at the weekly, here. If you look at the weekly, I just want to move these drawings up. This drawing up the way. Okay. If you look at the weekly, we have this long-term uptrend line, which we lost earlier in the week, but gold bulls did buy up the dip, and we are forming a bullish reversal hammer. We're doing that off the Middle Bollinger Band weekly, which also coincides with 20 MA, and we closed. Let's see here. Let's say that's a dead even, right at the uptrend line. So it's kind of teeter tottering. We'll see how it follows through next week. So yeah, that's my review on oil and gold and what we can expect in the coming few days. I hope you guys have a great extended weekend. Enjoy your weekends.